Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Suntien Green Energy Corporation Limited latest report. China Suntien Green Energy Corporation Limited offers a diverse range of businesses and services focused on clean energy. The company operates through three main segments: natural gas, wind power and solar power, and other. Under the natural gas segment, China Suntien provides construction and connection services for natural gas pipelines, sells natural gas and gas appliances, and invests in liquefied natural gas (LNG) projects. This includes LNG purchase, import, re-export, storage, transportation, and sale. In addition to natural gas, the company is also involved in wind power generation, including project investment, management, and operation of wind farms. It also provides technical services and support for wind power technology. The solar power segment includes development, management, and operation of solar power plants, as well as research and development of photovoltaic (PV) technology. China Suntien also engages in the sale of electricity to power grid companies and offers construction services for electric power transmission and distribution engineering. Furthermore, the company provides leasing of real estate, investment management, and enterprise management services. It also conducts safety production inspection and maintenance and operation of wind farms and PV stations. Overall, China Suntien Green Energy Corporation Limited is a comprehensive clean energy provider with a wide range of businesses and services that cater to various aspects of the industry. China Suntien Green Energy Corporation Limited market capitalization of 30 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that China Suntien Green Energy Corporation Limited holds a significant advantage in their industry. China Suntien Green Energy Corporation Limited trades at a higher price-to-earnings ratio of 9 times and a lower price-to-book ratio of 0.63 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 5.46%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, acquiring new natural gas end users, expanding transmission networks, and increasing cross-province upload sales have contributed significantly to revenue growth. Additionally, the expansion of urban gas projects, market share increase in the downstream industrial chain through mergers and acquisitions, and diversified sales strategies have also driven revenue growth. Furthermore, the growth from top customers such as Tianjin Binhai Zinao Energy Trading Co., Ltd. and Suntien Energy Co., Ltd. has been substantial, with increases of 3.54% and 1.98%, respectively. The expansion of wind and photovoltaic power generation revenue and natural gas sales revenue have also contributed to the growth in revenue. On the other hand, weakening market demand, decrease in transmission and sales volume of natural gas, and a decline in net profit from the natural gas business segment have led to revenue decline. The decrease in operating revenue due to a decrease in transmission and sales volume of natural gas has also been a significant factor, contributing to revenue decline. In terms of revenue neutral or no change, there are no specific drivers mentioned that have had a neutral impact on revenue growth or decline. However, it is worth noting that some pages mention both growth and decline drivers, indicating that the company's revenue growth and decline are influenced by multiple factors simultaneously. The net income of the company underwent a significant fluctuation between two periods. Initially, it increased by 6% from RMB 1,900,360,755.72 to RMB 2,013,916,855.3 due to enhanced profitability of independent energy storage projects and establishment of an incentive mechanism. However, in another period, the net income decreased by -29.6% from RMB 1,958,959,299.95 to RMB 1,382,722,761.46. The profit margins also experienced a mixed trend. On one hand, operating and net profit margins increased by 1.3 percentage points each from 10.9% to 12.2% and 8.9% to 10.2%, respectively, due to enhanced operational efficiency, technological transformation, optimized asset and capital governance, strengthened teams, and reduced risks. On the other hand, the profit margins decreased by -26.8% from 2.49% to 1.82%. This decline was attributed to an increase in non-operating income, decrease in impairment losses on fixed assets and goodwill, and increase in gains on disposal of assets. The reasons behind these changes are multifaceted and interrelated. The company's efforts to enhance profitability through independent energy storage projects and establishment of an incentive mechanism contributed positively to the net income and profit margins initially. However, the subsequent decrease in net income can be attributed to various factors such as increased non-operating income, reduced impairment losses, and higher gains on disposal of assets, which may have masked underlying operational issues. The company is generating significant positive operating cash flow, as evident from various financial statements across different pages of the report. On page 27, the net cash flows from operating activities amount to RMB 7,296,692,201.57, indicating a substantial inflow of funds into the business. This trend continues in subsequent years, with net cash flows from operating activities reaching RMB 7,297 million and RMB 3,721 million in 2025 and 2024, respectively. The company's cash balance as at the end of the reporting period also reflects this positive operating cash flow, standing at a substantial RMB 4,843,375,231.92. Furthermore, page 78 confirms that the operating cash flow for both 2025 and 2024 is positive, with amounts of RMB 7,296,692,201.57 and RMB 3,720,788,835.78, respectively. Additionally, on page 85, the net cash flows from operating activities are reported as positive in both years, with values of RMB 526,197,523.33 and RMB 735,666,296.2 for 2025 and 2024, respectively. Overall, these multiple indicators demonstrate that the company is generating substantial positive operating cash flow, indicating a strong financial position and ability to meet its obligations. The company's debt level has undergone significant changes over the past year. Initially, long-term and short-term borrowings increased by RMB 3.227 billion, no specific percentage change mentioned. However, this was followed by a substantial increase in total liabilities of $4.1 billion, 7.23%, on page 73. Furthermore, the net debt level has increased significantly from a decrease of $335 million to an increase of $1.79 billion. Additionally, non-current liabilities have risen by 15% from $2,181,305,808.69 to $2,205,862,013.64. On the other hand, interest expenses have shown a mixed trend. While there was no significant change mentioned on page 60, and limited information provided on page 68, interest expenses have decreased significantly, with an interest coverage ratio of plus 12.45% and EBITDA interest coverage ratio of plus 15.24%. The data also shows that interest expenses have decreased by 25.1% from RMB 34,233,818.42 to RMB 25,696,341.53 on page 82. Furthermore, interest expense has decreased by 10% from RM 0.35 trillion to RM 0.21 trillion on page 113. The performance of various segments and regions in the industry has been analyzed, revealing both successes and challenges. In terms of segments, the gas sector stood out as a top performer, with its segment on page 11 showcasing notable achievements. Additionally, wind power and solar energy segments demonstrated impressive results on page 121, while natural gas generation also showed strong performance in this area. The natural gas generation segment's success can be attributed to its ability to meet increasing demand for clean energy. On the other hand, the others segment struggled, indicating areas that require improvement or further investment. In terms of regions, northern China emerged as a standout performer, with page 122 highlighting its notable achievements in the industry. Overall, these results suggest that certain segments and regions are leading the way in terms of performance, while others may need to focus on improving their operations. Management is optimistic about the company's outlook due to government support for various initiatives, including offshore wind power development, green hydrogen industrialization, and clean energy policies. The strategy involves coordinated development of nearshore and deep-sea areas, investments in renewable energy technologies such as wind power, solar power, and hydrogen energy, and expansion of overseas business. The company is focusing on adapting to government policies that prioritize renewable energy development and utilization. This includes the implementation of green and low-carbon transformation of energy, which will drive the growth of new energy storage systems like pumped storage. To mitigate risks, management will continue to monitor exchange rate fluctuations and adopt relevant financial instruments. Management's strategy also involves securing quality upstream gas sources and developing new energy sources to accelerate China's transition towards clean energy and low carbon. The company has successfully issued H shares to raise capital for future growth, indicating a strong commitment to its expansion plans. Overall, the outlook is positive, driven by government support and a focus on sustainable development. The company has a history of paying dividends to its shareholders. In 2024 and 2025, it distributed a cash dividend of RMB 0.2 per share. This consistent payout indicates the company's commitment to returning value to its investors through dividends. There is no evidence in the provided summaries to suggest that the company has engaged in share buybacks. The focus remains on dividend payments, with specific amounts and totals reported for 2025. There are concerns about inventory buildup or supply chain disruption in the industry. The data suggests that inventory levels have been increasing, with a notable 7% rise from 2024 to 2025, page 101. This increase could indicate potential issues with inventory management and potentially lead to supply chain disruptions. However, it's also worth noting that there was a significant decrease in inventory of 155 million RMB from last year, page 72, which may be a one-time occurrence rather than a long-term trend. Nevertheless, the overall trend of increasing inventory levels raises concerns about the potential for inventory buildup and supply chain disruptions. That concludes the financial summary for China Suntien Green Energy Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.